Imagine handing the keys to your 20 million rand business over to a family trust, you know, just to keep it safe for your kids.
Right.
You're feeling incredibly proud of yourself for securing their future, and then a year later, the South African Revenue Service knocks on your personal front door,
Oh, yeah.
and they are demanding this massive check for income taxes on money that you don't even have anymore.
It's brutal, but it happens way more often than you would think.
So today, we're doing a deep dive into why the ultimate wealth protection tool is, well, secretly bankrupting South African business owners who just, don't read the fine print.
Yeah, people assume putting assets into a trust is like a magic invisibility cloak or something.
Yeah.
But they completely miss the landmines hidden right under the surface of the tax code.
Exactly. And that is our mission for this deep dive. We're going to shortcut your path to becoming exceptionally well-informed about the very real, incredibly positive power of trusts in South Africa. But, without letting you step on those landmines. So to do this, we're looking at a pretty fascinating stack of sources today.
We are.
On one hand, we have detailed South African tax law, specifically something frankly terrifying called the attribution back to donor provision.
Sounds scary just saying it.
It really does. And then on the other hand, we have the highly practical strategic framework of South African trust consultant Lunka Sturman.
And honestly, the contrast between those two sources is where the real value lies here. I mean, the tax code basically tells you every way you can fail.
Right.
But Lumka's consulting methodology provides the actual blueprint to, legally and safely build your wealth.
Okay, let's unpack this. Because before we get lost in the weeds of the Income Tax Act, we really need to establish why you would even go through the hassle of setting up a trust in the first place.
Yeah, it's a good question.
Like, why not just build your business in your own name? I mean, when you start out, it's usually just you and your laptop, right?
Or you and a single backy, yeah.
Exactly. You just put everything in your personal name to keep things simple.
Well, keeping things simple is fine for day one. But as your operation grows, that simplicity morphs into a phenomenon that we can call entanglement.
Entanglement, okay.
Yeah, think about your typical entrepreneur. They build a really successful trading company. That company starts buying heavy machinery, or maybe it buys the huge warehouse it operates from.
Right.
But to fund all this, the bank asks the founder to sign a personal surety.
Oh, always. Because banks always want the founder on the hook, personally.
They absolutely do. So over time, this entrepreneur, they buy a nice family home, maybe some investment properties. They build up a stock portfolio, all in their personal name.
Okay, making good money.
Doing great. But here's the critical flaw with all of that. All of their personal wealth and all of their business risks are now swimming in the exact same pool.
Oh, I see.
So if the trading company hits a catastrophic wall, say there's a massive lawsuit from a client, or an unexpected liquidation, or just a brutal SARS audit, the blast radius doesn't stop at the company doors.
Ah, so the creditors can pierce right through the company to the founder.
Precisely.
Meaning your family home, your kids' college fund, literally everything you spent 20 years building is suddenly on the table to pay off a business debt.
It is the ultimate nightmare scenario. You are the business, and the business is you. Your risk is entirely unmanaged.
Wow. Which I guess brings us right to Lunka Sturman's core concept, right? The asset protection fortress.
Yes.
It's a very visual way of thinking about structuring. It's like putting your noisy, dangerous marketplace outside the castle walls, but keeping your actual gold vault locked deep inside the keep.
That's a great way to look at it.
Right. Like, if the market catches fire or gets attacked by bandits, it's a bad day, sure. But the vault is perfectly safe. You can rebuild the market tomorrow because your underlying capital was never touched.
Exactly. And if we connect this to the bigger picture, this is exactly the mechanism wealthy families have utilized for centuries.
Well, really?
Yeah, to protect their estates across generations.
Right.
The fundamental rule of old money is they never own things directly. They control entities that own things.
Yeah.
And Limke's entire philosophy is that small and medium business owners in South Africa need to apply those exact same principles today.
Makes sense.
The fortress separates your power from your liability.
Mm-hmm.
So your trust owns the valuable assets, the property, the IP, the heavy equipment, and it just leases them to your operating company.
Okay.
The operating company takes on all the client risk, but it technically owns very little.
So if the operating company gets sued, the creditors look at the books and realize, wait, there's actually nothing here to take.
Nothing at all.
The company is just an empty shell running operations, while the real wealth is sitting securely in the trust. I mean, it sounds like a flawless dream.
It does.
But looking at our tax sources here, I'm guessing this is where the dream hits a rather cold, hard reality.
Yeah, that reality has a name. It's Section 7.5 of the Income Tax Act.
Section 7.5?
Yes. It is basically a massive trapdoor installed right in the floor of your fortress. And honestly, it catches so many people completely off guard.
Okay, so I was actually reading through this rule, this attribution back to donor provision, and I'm genuinely scratching my head here.
It's confusing.
It sounds totally backwards. It reads like SARS is taxing me for money that went into someone else's bank account. Am I misreading this?
No, you were reading it perfectly correctly.
Really?
Yeah. In the tax world, attribution is it's a mechanism that assigns taxable income to someone who didn't actually receive the physical cash.
Okay.
So if you donate an income-producing asset to your trust, Section 7.5 dictates that the income generated by that asset is legally deemed to be your personal income.
Wow.
It is taxed in your hands at your personal marginal tax rate, even though the trust physically collected the money.
But why on earth would the law be written like that? I mean, if I give an asset away completely, I don't own it anymore. It's not mine. Why is SARS punishing me for someone else's revenue?
Well, they wouldn't call it punishment. It's preservation.
Preservation of what?
The tax base. South Africa operates on a progressive tax system, meaning, the more you earn, the higher your percentage of tax.
Right, up to 45%.
Exactly. So the policy rationale behind Section 7.5 is strictly anti-avoidance. Let's say you are a high earner pulling in 2 million Rand a year, putting you squarely in that highest 45% tax bracket.
Okay.
Without this attribution rule, you could just donate a bunch of your investments to a trust. The trust earns the dividends and then distributes that money to your retired parents or your kids who are in a much lower tax bracket.
Right, they might be paying 18% or even zero.
Exactly.
Okay, I see it now. You would just be shuffling paper around to illegally slide out of your high tax bracket while your family still gets to enjoy the exact same pool of money.
Right. It would break the progressive tax system overnight. Everyone would do it. So the law steps in and basically says, if you donated the asset that laid the golden egg, you are paying the tax on the egg.
Let's run some actual numbers on this because I want to see how badly this can hurt. Our sources use a rental property example that honestly made me wince.
It's a sobering example.
So let's say I have a property that brings in 30,000 Rand a month in rent.
Okay.
That's 360,000 Rand a year. And let's assume I'm in that 45% tax bracket.
Right.
If I keep the property in my own name, that rent adds 162,000 Rand to my personal tax bill.
That is the standard baseline, yes. That's what you owe.
Okay, so wanting to build my fortress, I say I'm going to donate this property to my new family trust. The trust takes over the deed.
Yep.
The trust collects the 360,000 Rand in cash from the tenant every year. But under Section 7.5, SARS looks at me and says, you still owe us 162,000 Rand.
They do.
Wait, if the trust gets the 360,000 in cash, but I get the 162,000 tax bill, how do I actually pay SARS? I don't have the rental income anymore.
And that realization right there is what the sources identify as the second biggest mistake business owners make.
What's that?
Zero cash flow planning. Attribution doesn't erase the tax liability. It forcefully pins it to the donor. SARS does not care that the cash is sitting in the trust's bank account. You personally have to find 162,000 Rand.
That is a cash flow nightmare. I mean, I'd have to pay it out of my own salary.
Yeah.
Or I guess the trust would have to declare a distribution back to me just so I can pay the tax. But that defeats the whole purpose of putting it in the trust to begin with.
Exactly. It creates this vicious circular flow of money that can completely cripple an entrepreneur's personal finances. I mean, people literally go bankrupt because they donate assets without understanding the attribution trap.
Okay, well, if donating the asset is a giant trap, then the obvious solution is just don't donate it.
Right.
What if I just sell the property to my trust? The trust buys it from me at fair market value. I haven't donated anything. Surely that bypasses the whole Section 7.5 attribution nightmare.
Selling it does bypass the donation rules, yes. But before we explore how you actually structure that sale, We really have to look at a crucial distinction the sources make here,
Okay.
because it changes the entire strategy of what kind of assets you should be putting into a trust in the first place.
All right. What's the distinction?
You have to understand the difference between income yield and capital growth.
Hang on. If I donate a business to my trust, and over 10 years that business grows in value by 12 million rand, why doesn't SARS attribute that 12 million back to me? Isn't growth just another form of making money?
It is, but the law treats them very differently. Attribution rules specifically target income.
Like cash coming in.
Exactly. Things like monthly rent, annual dividends, or interest payments. It does not target capital gains.
Okay.
A capital gain is the appreciation in the underlying value of the asset itself. And this is a massive, entirely legal planning opportunity.
Oh, wow.
The most strategic move you can make is to put assets into your trust that have a low current income yield, but a massive potential for future capital growth.
The sources actually use a franchise business as an example for this, and it really clicked for me when I read it.
It's a perfect example.
So let's say you own a relatively new franchise. Today, it's worth maybe 8 million rand. You donate the shares of that business to the trust.
Right.
Now, yes, while you are alive, whatever small dividends the business pays out will be attributed back to you. You pay the income tax on those dividends.
Which is manageable.
Right, it's manageable. But let's fast forward. You pass away 20 years from now. That franchise has exploded and is now worth 20 million rand.
And that is the exact moment the strategy pays off. When you pass away, attribution legally ceases because a deceased person cannot earn income.
Obviously.
But more importantly, that 20 million rand asset is sitting safely inside the trust. It never formed part of your personal estate.
And in South Africa, estate duty sits at 20%, right?
It does.
So if that 20 million rand business had been in your personal name when you died, SARS would take roughly 4 million rand in estate duty before your kids ever saw a single cent.
Yes. Let me put an even sharper point on that, actually. By having the trust own the high-growth asset from the beginning, your children inherit the total economic benefit of a 20 million rand business.
Wow.
Without inheriting a mountain of taxable income and without the family losing 4 million rand to estate duty.
That's incredible.
You absorbed the small income tax hits while you're alive, but you protected the massive capital growth for the next generation.
Here's where it gets really interesting.
Okay.
Let's go back to my idea of selling an asset to the trust. Let's say I have an asset that does generate a lot of income, and I just refuse to deal with the attribution trap.
Fair enough.
I want the trust to pay its own tax. So I sell the asset to the trust at fair market value, but my trust is brand new. It has zero money in its bank account.
Right. It can't pay you.
Exactly. So I say, no problem, I will sell you the asset and I will just loan you the purchase price. And because it's my own trust, I'll make it an interest-free loan. I mean, that used to be the ultimate loophole, right?
Oh, it was the standard playbook for decades. You sell the asset, leave the purchase price on an interest-free loan account. The trust earns the income, pays its own tax, and you slowly draw down the loan completely tax-free.
Beautiful.
It worked beautifully until 2017.
What happened in 2017?
Well, the South African Parliament got tired of losing tax revenue to that loophole, so they introduced Section 7C of the Income Tax Act.
The 7C. Okay.
Section 7C specifically targets the interest rate on loans made to trusts. It dictates that if you give a trust a loan at an interest rate that is lower than the official repo-linked rate,
Right.
the foregone interest, meaning the interest you legally should have charged but chose not to, is treated by SARS as a deemed donation.
A deemed donation. So SARS just pretends I physically handed the trust a bag of cash.
Exactly. It is a legal fiction, but the resulting tax bill is painfully real.
Yikes.
Let's run the numbers from the source material. Suppose you lend your trust 10 million rand, interest-free, to buy a commercial building. Let's say the official interest rate set by the government is 8%. SARS looks at your arrangement and says, you should have charged the trust 800,000 rand in interest this year.
Because 8% of 10 million is 800,000.
Exactly. But because you charge 0, we deem you to have donated 800,000 rand to the trust.
And in South Africa, donations attract a 20% donations tax.
Yeah.
So 20% of 800,000 rand, that's 160,000 rand tax penalty.
Every single year.
Every single year. Just for the privilege of giving your own trust an interest-free loan.
That is the reality. Section 7C forces business owners into a very difficult strategic corner. You essentially have to choose your poison here.
What are the choices?
Choice 1, you charge the trust the official 8% market rate interest. That avoids the deemed donation completely.
Right.
But now, the trust actually owes you 800,000 Rand a year in cash, and you have to declare that 800,000 Rand on your personal tax return as taxable interest income.
Which puts us right back into a cash flow nightmare, because the trust might not be making enough rent to pay me 800,000 rands in interest.
Precisely. It might not have the cash.
Yeah.
Or you take choice two. You stick with the interest-free loan, except that Section 7C applies, and you pay the 160,000 Rand donations tax out of your own pocket every year.
Wow.
You are either paying income tax on the interest or donations tax on the free loan. There's no longer a free lunch.
Wow. Okay, so we've established that the Asset Protection Fortress is an incredible, essential structure for shielding wealth and securing a legacy.
Essential. Yes.
But the moat around this fortress is just filled with tax landmines. We've got Section 7.5 attribution on income. We have to balance capital growth against yield. And if we use loans to avoid attribution, we trigger Section 7C deemed donations.
It's a lot to navigate.
How does a normal, busy entrepreneur actually implement this without making a fatal, bankrupting error?
That is the core challenge. The sources outline a few strategic paths, and a major one is the principle of gradual transition.
Gradual transition.
Yes, you do not have to move your entire 20 million Rand empire into a trust on a Tuesday afternoon.
Well, I noticed the sources mentioned an annual donations tax exemption. How does that play into the gradual strategy?
It's a great tool. South Africa currently allows every individual 100,000 Rand annual exemption from donations tax.
Okay.
So if you have that 10 million Rand loan account with your trust, you can legally forgive or donate 100,000 Rand of that debt every single year.
Oh, without triggering the 20% tax.
Exactly. It's a way to slowly bleed down the loan balance and gradually build the trust's unencumbered ownership over a decade or more.
That's smart.
It requires patience, but it completely avoids those massive, immediate tax events.
The sources also highlight a massive psychological trap. So many people try to DIY a trust purely because, like, a friend at a Bri told them it was a great way to dodge income tax this year.
Oh, the Bri advice is the worst.
Right. And as we've just learned with the attribution rules, it absolutely does not do that.
Not at all. And this raises an important question about intent. If your only motivation for setting up a trust is short-term income tax evasion, you are going to be severely disappointed.
And heavily penalized.
Likely heavily penalized by SARS, yes.
Yeah.
The focus has to be on the long-term, true benefits. Insulating your operational risk, saving millions in future estate duty, and ensuring smooth succession planning when you pass away.
Which really brings us back to the insights from Limke Sturman. Because everything we've discussed today screams one undeniable fact. You cannot do this alone.
No.
You can't just download a generic free trust deed off the internet, fill in your name, and assume your family's future is secure.
You absolutely cannot. The complexity of how your specific business operates dictates the entire structure.
Right.
Like, do you take a salary or dividends? Are your assets high growth like tech stocks or high yield like rental flats? Are you personally guaranteeing company debt?
A generic template won't ask any of those questions.
Exactly, which is where a specialized trust consultant becomes invaluable.
Looking at Limke's website, what I really appreciate is how transparent she is about what professional structuring actually looks like. She's not just selling a piece of paper.
No, it's a whole process.
She offers a foundation audit for 25,970 Rand. Now, at first glance, someone might think, wow, that's a lot of money just to look at my setup.
Sure, sounds like a lot.
But it's a deep dive into your personal versus business exposure. It assesses if you are actually ready for a trust and maps out the exact legal structure you need. And she also offers an asset protection blueprint session to physically map the flow of assets.
Right, and when you contextualize that cost, it becomes a completely different conversation.
Yeah.
Is 26,000 Rand a significant investment? Yes.
Yes, of course.
But compared to the examples we just walked through, if you mess up a single interest-free loan because you DIY'd your trust, Section 7C will hit you with 160,000 Rand donations tax penalty.
Yeah.
Every single year.
Yeah, puts it in perspective.
Or worse, you lose a 20 million Rand business to a personal lawsuit because your assets were entangled. Professional guidance at this level isn't an administrative expense, it is vital risk mitigation.
It's the cost of paying a master builder to pour the concrete for your fortress properly instead of trying to stack the stones yourself in the dark.
Exactly.
For anyone listening who realizes right now that their personal assets are terrifyingly tangled up in their business risk, you can explore these exact strategies and book a consultation directly at www.limke.com. lumcasterman.com. It is incredibly educational and clearly laid out.
Highly recommend it.
So what does this all mean? It sounds to me like the true secret to trusts isn't about finding some magical, sneaky loophole to cheat the taxman today.
No, not at all.
It's about trading a little bit of administrative effort and paying professional fees right now so you can legally and safely shift all the future growth and all the future risk entirely away from yourself.
What's fascinating here is how it completely reframes the concept of wealth building. Trusts are not tax evasion tools. They are structured value transfer mechanisms.
Structured value transfer, I like that.
Yeah. Yes, you will pay the tax you owe while you are alive and generating income. The system is designed to ensure that.
Right.
But in exchange for playing by the rules, you are utilizing legal frameworks to secure your family's financial future permanently. You are ensuring that what you build outlives you and, crucially, outlives your liabilities.
It's about having the discipline to play the long game. Let's quickly recap the journey we've been on today. We started with the dream, right? Building the asset protection fortress. We learned why you must take your risk-heavy operating business and separate it from your wealth-holding trust.
Then we confronted the reality check, the hidden trapdoor of the attribution back to donor provision.
Right.
We learned that if you donate income-producing assets, the tax liability sticks to you like glue.
And we explored the mechanics of navigating those traps. We broke down why balancing current income against future capital growth is the secret sauce.
Crucial point.
We saw how selling assets and creating loans triggers the Section 7C deemed donations tax, and why a gradual transition is often the smartest path forward.
Most importantly, we established that navigating this minefield requires professional alignment. Your immediate tax strategy, your long-term estate planning, and your daily business operations must be perfectly synchronized.
And that is exactly why building this fortress is absolutely not a weekend DIY project. If you are out there generating income and building real assets, you have a responsibility to ensure they are protected.
You really do.
You can go to www.lumpesterman.com to look at getting your own foundation audit or blueprint session and actually get this handled by a specialist who understands the landscape.
It truly is the difference between hoping you are safe and legally knowing you are protected.
Exactly. So as we wrap up this deep dive, I want to leave you with a thought to mull over tonight. Think about your own business right now. Picture the noisy marketplace and picture the fortified castle.
Good visual.
If the unthinkable happened tomorrow morning, a massive lawsuit from out of nowhere or a sudden unexpected tragedy, what would actually survive the siege? Are you just building a business that pays your bills today, or are you constructing a legacy with a vault strong enough to protect your family for the next 100 years?